Now, we've looked at our basic introduction of what we're trying to do here. Now I think we need to consider the key financial management decisions. When we look at the financial management decisions, what we're focusing on is quite often what is the introductory chapter in any textbook. And we're doing this for two reasons. The first reason is we need to understand the sort of things that we have to do. But the second reason is far more important. Yes, this is an introductory paper. I think I've said that 4 times now. And as such, your examiner could easily mine this area for a few marks. When we're looking at financial management, it's often broken down to 3 simple decisions. First of all, the investment decision. Where are we going to invest our money? Second of all, the financing decision. How do we fund that investment? And thirdly, the dividend decision. Let's look at the investment decision first of all. If we're looking at investment, in simple terms, there are 3 areas that we can invest in. We can either invest in capital assets. You know, land and buildings or machinery. We're investing in land and buildings or machinery in order to generate what? A return? To make money. Secondly, we could invest in working capital. And finally, we can invest in financial assets. You know, we could invest in what? Shares of another company, or we could put the money in the bank and earn interest. All I want to look at here is this. If we're investing in capital assets, land and buildings or machinery, what are the key concerns? Well, to my mind, 2 must always spring to mind. The first one is return. We're investing in these assets to generate a return, however we define that. Later on, we're going to say, well, return could be profit. Or more importantly, we come across a concept called net present value, which is fundamental to so much that we do in this paper. Inextricably linked to return is risk. I think we can all appreciate that if a project is more risky, we would expect a higher return in relation to that risk. You could argue that when you look at FM, it is a study of risk. And as such, it underpins so many parts of what we do on this paper. So, we're looking for return, but at the same stage we have to assess the risk. And the degree of risk will determine the amount of return that we need to earn. There are other considerations, of course. You could say when we're investing in capital assets, we have to consider short-term profitability. If we're making a major investment, and yes, we expect it to generate a return into the future, what happens if the profitability of the business is very poor in the first and maybe the second year? Well, yes, if we have very poor short-term profitability, this could damage the company so much that we never get the return that we're looking to get. In simple terms, if we're making enormous losses in year 1 and year 2, the company could fail, or the share price could be depressed so much that somebody else is easily able to buy us out. Therefore, the existing shareholders suffer and the new shareholders will benefit. So we have to be aware of short-term profitability. And finally, we have to consider the wider liquidity considerations. When I focus on liquidity, what I'm talking about is this. We have to have the cash, of course, to be able to make the investment. But not only that. If we're going to invest in a machine or a building, we will be employing people to operate that machine or inhabit the building. If we have a new process, we will need stock or inventory, and maybe we will have increased receivables. All of these eat up cash. As such, when we're making an investment, we have to consider the wider liquidity considerations. Do we have the cash to operate or inhabit our asset? If we don't have them, what can we do? The possibility is we run out of cash and fail. So if we're looking at capital assets, I would agree that the two key considerations are risk and return. But we cannot ignore the other considerations as well. Now we move on to working capital. If we look at working capital, we have two conflicting issues. Remember, working capital itself does not generate a return. All it does is allow those capital assets to operate. Often we describe working capital as the lifeblood of the business. It is the cash that allows us to buy things, that allows us to employ people, that allows us to hold stock or inventory, that allows us to offer credit to our customers. As such, the first thing we have to say is simply this. We have to have enough. Because if we don't have sufficient working capital, the one thing that we'll give is the cash position. Therefore, the first issue is this. We need sufficient working capital to avoid running out, to avoid insolvency. Because if we run out of cash, we are in trouble. On the other hand, we don't want to hold too much. Every pound invested in working capital is one less pound that we could invest in capital assets. Remember, capital assets generate the return. If we invest in, say, stock, does it generate a return? Well, the answer is no, not directly. And from that perspective, we want to limit the amount of working capital. We want to minimize working capital to improve profitability. In simple terms, if we have the lowest working capital, we have the highest possible profitability. Now, we will talk about that later, but all I would like to say at the moment is that it is a balance. Nothing more, nothing less. When we talk about working capital management, the key feature here is to reconcile, one, the insolvency issue, with two, the efficiency or profitability issue. Finally, probably of slightly less importance, but worth discussing while we are here. When we look at a financial investment, what are the considerations? Well, to my mind, what I want to do is to take the considerations that we've looked at in terms of a capital asset, or at least three of them. We could say we've got return, risk, and liquidity. And all I would like to add is this idea. We've got short-term and long-term investment. If we're looking at a short-term investment, well, think of it this way. Let's say that you're putting money away for a hard-earned holiday in 2 months' time. With a short-term investment like that, you're putting your money away in the bank. But the key feature is that you need it in 2 months. You need that holiday. If that's the case, are you going to risk that money disappearing? Well, I think most of us would say no. With a short-term investment, the critical consideration, ranked number one in our mind, would be risk. We must ensure that when we go back to that money is still there. Therefore, we want the investment to be risk-free, or as risk-free as we can make it. The second consideration for short-term investments is liquidity, or we could describe this as marketability. What I mean by that is that we have to be able to convert it back into cash when we need it. And of course, return is important. But return is only important after the other two considerations. So short-term investments, yes, we want a return, but we are willing to accept a lower return in order that we get minimal risk and a liquid asset, something that can easily be converted into cash. If we're looking at a long-term investment, let's say you're saving for your retirement. If that's the case, you could argue that you speculate to accumulate. And as such, what we should focus on first of all is return. Now, of course, the return will be balanced by risk. But there are many theories that suggest that risk evens out over time. And from that perspective, return is number one. And you could argue that if you're putting money away for 5, 10, 15, 20 years, liquidity is not an issue, at least not at the outset. So, if we're looking at the first issue here, we're looking at investment. All I've tried to do is to highlight a few ideas. Of course, each of these areas, particularly the first two, capital assets and working capital, we will come back and discuss in some depth later. But here are a few ideas that could come up as a 3 to 5 mark answer in the exam. Moving on. Secondly, what I want to look at are the financing issues. When we come to finance the business, what I've tried to do here is to come up with the key questions that we must ask. Now, if we're looking at questions, the first question is simply this: how much is needed? How much funding is needed for the business? Well, if you think about it, this goes back to the accounting equation that we started with. We said the funding of the business in terms of debt, you know, loans, loan notes, bank loans, that sort of thing, or shares, equity, that sort of thing, must equal the use of the funds in terms of the investment in the capital assets plus the working capital. So in simple terms, it's quite a basic idea. But hold on a moment. This used to be a very popular question at this area. And it's a fundamental question for any business. What we could do is we could focus on the requirement on the one hand and the funding. I suppose I could say the existing funding. Because, of course, from year to year, they will change. If we're looking at the requirement, we could say we start with our existing capital assets and working capital. Given that we have our existing capital assets and working capital, the next thing we have to do, of course, is add or subtract any investments or disposals. You know, we're looking at capital assets here. Are we going to invest in anything new? We'd have to add that one in. Or are we disposing of anything and getting some cash back? Secondly, we would have to add or subtract for any change in working capital. When we're looking at working capital, what we would normally suggest is this. The amount of working capital that we need is proportionate to the level of activity. So, for example, if we sell 10% more, maybe we expect 10% more working capital to be needed. Something of that nature. As such, if we're looking at the requirement, the net of these will be our requirement for the year. The amount that we would need. When we look at funding, of course, we would start with our existing funding. And all we want to look at here is how would the funding change? Well, of course, we may have to add in some retained earnings. Now, I use that term loosely here. We'll come back and discuss it in a moment. But what I'm really talking about is cash generated from operations. So in simple terms, we are saying that if we generate substantial cash from the fact that we sell for more than we pay the goods, those funds will come free within the business. Secondly, of course, we would have to add or subtract for any new loans or redemption. And likewise, we would have to add or subtract in relation to any share issues or redemptions. Now, those are the bits that we're told about. Now, of course, therefore we will get the funding for the year. And what we want to do is to make sure that those equate. In a situation where we have insufficient funding, which is the likely issue, then what we would have to do is find a way of raising the extra amount. Now, this was a popular question in the past. And I've got a feeling, because we now have a comprehensive financial management paper here, this is the sort of question that could arise in the future. It's a fundamental issue. If you don't balance, you've either got too much funding, that's inefficient, or too little funding. Well, in that circumstance, we could run out and fail. Okay. Second question. When we're looking at the funding, do we use internally generated funds? Or do we use externally sourced funds? Well, I think most of us would be inclined to use internally generated funds first. We do that first because, of course, that's the easy thing to do. If we've generated cash from operations, of course, we would reinvest that first of all. That's fine if we generate a lot of cash. If we don't, of course, we would have to resort to external funds. So, if we're not generating substantial cash, or we're trying to grow the business very quickly, then we would have to resort outside and maybe raise funds via a bank loan or through shares. That brings us to the third question. The third issue is, if you wish, the gearing question. Do we fund the business by debt or equity? Do we wish to take out a bank loan, or do we wish to issue more shares? Now, we are going to look at this area in many different ways. We're going to look at it in terms of the impact on ratios. We're going to look at it in terms of maybe the costs of the issues. We're going to look at it on its impact on the overall financing cost of the business. And we're going to look at specific capital structure theory relating to this. we would expect something in this area to come up most times in the exam. Fundamental. Do we fund by debt or equity? And then the final issue, if we're looking at the debt, do we fund by short-term debt or do we fund by long-term debt? A very simple issue indeed. This is covered when we look at working capital. In particular, when we're funding working capital, do we use what is described as a conservative or what is described as an aggressive financing policy? Again, not difficult. It comes up on occasion. So to recap here, we have 4 considerations. How much do we need? Do we fund from internally sourced funds or externally raised funds? Do we use debt or equity? And given that we use debt, would it be short-term or long-term? 4 fundamental questions that we ask ourselves, from which we can determine classic questions that the examiner will ask. Well, okay, so we've looked at the financing question. The final one is dividends. I suppose what we're saying is, how much do we pay? Now, of course, we could talk about dividend policies. We'll come and briefly discuss that in a moment. But all I like to do is to consider what are the issues when it comes to paying a dividend. Now, most of you know the financial accounting consideration, and that is simply the fact that dividends are an appropriation of profit. You can only pay a dividend out of distributable reserves, i.e. retained earnings that have been generated over time. So the first consideration is simply this. You have to be profitable. If you're not profitable, over time you can't pay a dividend. Secondly, and maybe a far more concern to me, is that dividend is a cash outflow. If that's the case, liquidity is an issue. If you ain't got the cash, you can't pay your dividend. As simple as that. Thirdly, growth. I suppose growth of the business. If you are intending to grow the business quickly, you know the business is hungry for cash. And if the business is hungry for cash, then you can't pay substantial dividends out. Or if you do, it's maybe a slightly mad thing to do because you're paying cash out of the business and then you're raising cash from elsewhere. Quite inefficient. And from that perspective, what you may attempt to do is to pay a very small dividend and retain the cash in order that you can grow your business organically from within. The last major consideration is, unfortunately, our investors have an expectation for a dividend. Particularly if we are a PLC, a listed company, our investor expectations will be very important indeed. If we look at investor expectations, what we're simply saying is this. Investors expect a constant dividend year on year. They do not want surprises. As such, although our profits may bounce up and down, we tend to smooth the dividend so it is similar each year, hopefully growing a bit each year, to suggest that the business is becoming more profitable. It is a very, very foolish company that ignores investor expectations. Because if we cut the dividend suddenly one year, we are likely to upset or even alienate our investors. As such, shareholders may dump our shares and we could be in trouble. Therefore, whatever dividend policy we adopt, it must take that into account. Finally, is an area I'm not particularly excited about, but of course we have to remember that we could put legal restrictions into how much dividend is paid, at least for private companies, smaller companies. Now, of course, my legal knowledge is a bit hazy. I learnt it many years ago, but I seem to remember that you can either restrict the amount of dividends that you pay out within the articles or the memorandum to the articles. Of course, this is not a major issue, but it could be a mark earner in the exam. So we've looked at our three basic decisions. Be ready for them. I think, from my perspective, this is an interesting introduction to what we are trying to do. But importantly, it could score marks in the exam. And remember, it doesn't matter how big the mark allocation is to a question, you've got to answer each and every bit. Now let's move on and look at what our aim is. What is our aim when it comes to financial management? Well, simply, our aim is to maximize shareholders' wealth. We consider the shareholder to be the key stakeholder, and as such, our aim is to maximize their wealth. The issue is, what does it mean? What is wealth? Well, maybe what we could do is start with the basic sort of aim that I think most of us have taken on up until this point. You see, if we were to look at other aims, ones that are maybe related to what we're doing here, I think most of us would understand the idea of maximizing profit. Is maximizing profit the same as maximizing shareholders' wealth? Well, the answer is yes. There is some link between the two. If a company consistently generates its maximum profits, we would expect that to feed through in some way to the wealth of the shareholder. But there are two issues that maybe we could consider here. If we were to look at the difference between wealth and profit, two things spring to mind. The first is this. When we calculate profit, over what time period do we expect to calculate the profit? Well, yes, we would normally calculate profit over 1 year, wouldn't we? Whereas when we're looking at shareholders' wealth, what sort of time period are we talking about? Well, are we talking about today? Well, yes, we want to ensure that we enhance the wealth today. Are we talking about in 1 month? I think we are. Are we talking about in 1 year? Yes. Are we talking about 5 years? So shareholders' wealth is an interesting idea. We're not looking at a specific point in the future. We are suggesting that shareholders' wealth is the wealth today and ongoing into the future forever. As such, the time period is an issue. I think we all know that we can all manipulate profit in the short term. But if we manipulate profit in the short term, it will come back to bite us in the long term. A specific concern there. The other thing that I would get excited about is this. When we maximize profit, I suppose what we're talking about here, or at least we learn in management accounting, is that we're talking about operating profit, or PBIT, profit before interest and tax. If you wish, the profit from operations. Now hold on a moment. Is that directly related to shareholders' wealth? Well, the answer is no, because that profit can be used to pay debt holders and shareholders. And hold on a moment, that profit is before tax. So what we have to consider here is that when we're looking at maximizing shareholders' wealth, we focus on the key stakeholder. We're much more concerned on making sure that the shareholder, the owner of the business, benefits from being an owner. So, in recap, the first issue I would point out is this. Yes, there is some link between earning a profit and generating shareholders' wealth, but they are not the same for the two reasons that we've discussed here. Before we go on, there could be other aims beyond maximising profit. You could argue that some companies attempt to maximise sales. And maybe the reasons why they're doing this is, what? Going in at a low price, trying to generate substantial sales, maybe get market share, on the basis that once they've got market share, they can convert it into profits in the future? Yes, this may happen in the short term. A lot of companies go for growth. We could argue more cynically that a lot of companies satisfice. The idea of satisficing is that if you look at most companies, they really don't maximise profit. They don't maximise shareholders' wealth. They don't do that because they're happy being within the environment where they are confident that they can make a profit. The idea behind satisficing is that we offer a satisfactory profit, an acceptable level of profit, but at a minimum of risk. And I think if you look at most companies, maybe the company that you're working for, that's probably what they do. They go for enough profit, but at the same stage, they try and stay within an environment within which they feel confident and happy. So, these are the sort of other aims that we may consider. Now, given that we've looked at this basic aim, can I point out, before we go any further, that everything that we look at from here on in is based on the idea of maximising shareholders' wealth? Quite a difficult concept, but something that we have to hold at all times from here on in. Our final topic in this area is to focus on a stakeholder concept. Now, this is really away from what we've been talking about, but it's been a common question in the past. So what is a stakeholder? I think a lot of us know examples of a stakeholder. What we could say is that a stakeholder has an interest in the business. They are maybe affected by the business. And very importantly, a stakeholder will have an influence on the business. And what we're trying to highlight here when we look at stakeholders is that we should maybe not focus just on the shareholder. We know that the shareholder is a stakeholder, but at the same stage there are many other interested parties, and all of those interested parties are vital to the success of the business. If you remember, the idea that they have an influence. Without that interested party, the business cannot operate. Now, with that in mind, this is the basic idea. Here we have, what? A cake, a pie, or shall we say a pizza. And what this does is, if you wish, reflect the available return from the business. Now, I don't mean available return in terms of profits. I mean return in terms of the critical measure for the individual stakeholder that we focus on. If that's the case, the basic idea is this. We will parcel out the amount of return to the stakeholder in proportion to the degree of influence that those stakeholders have within the business. Some stakeholders, maybe shareholders, deserve more because they have more influence. And some stakeholders, don't know, we'll come up with some examples in a moment, deserve less because they have less influence. This is the basic concept. What we need to know with stakeholders are this. First of all, what they are. Secondly, the measures that they would assess in terms of the company. And thirdly, and it appears to be quite an important exam point, any conflicts that we would expect between one stakeholder group and another.